Welcome to the Deep Dive. Today we're jumping into the Philip Morris International Q3 2025 results. The earnings call was pre-market October 21st.
And the main story here is kind of wild, isn't it? A real beat and bleed.
Exactly. Strong numbers reported, beat expectations, but then the stock just tanked. We're talking, what, down 9% midday?
Yeah, a really sharp drop. It tells you the market was looking past the headlines and focusing hard on, well, the investment costs underneath.
So let's start with those headlines, because on paper, they look fantastic.
Absolutely terrific, yeah. If you just saw the numbers flash up, you'd think everything was rosy.
Okay, so adjusted EPS came in at $2.24. That's up a solid 17.3% year over year.
Mm-hmm. And that comfortably beat the consensus estimate, which was around $2.10, so a strong beat there.
And the top line, too.
Same story. Net revenue hit $10.85 billion. The street was looking for about $10.7 billion, so that's up 9.4% year over year. Good growth.
And operationally, things looked efficient as well. Operating income grew, what, 16.7%?
Yeah, to $4.26 billion. And the adjusted operating income margin, that expanded too, up 120 basis points year over year.
Landing at 43.1%, which, you know, getting over 40% operating margin in consumer goods is, well, it's pretty exceptional, right?
It really is. Shows strong cost control, definitely. Before you even get to the spending questions later.
And a lot of that strength, that margin performance, it ties directly back to their big strategic shift, doesn't it? The pivot to smoke-free.
Absolutely. It's not a side project anymore. It's becoming the core business.
Yeah, I mean, look at the numbers. Smoke-free products are now 41% of total revenue.
And crucially, for profit, over 42% of the company's gross profit. That's where the value is shifting.
The growth rate there is also really strong. Smoke-free net revenue jumped 17.7% year over year.
Or 13.9% if you look at it organically, stripping out currency effects and M&A. Still very healthy growth.
You can really see this playing out in the volumes. Total shipment volume was, well, almost flat, up just 0.7%.
Right, which sounds underwhelming, but underneath that flat number, there's this huge shift happening.
Because heated tobacco units, the HTUs, their shipments surged 15.5%.
Yeah.
That's 40.8 billion units.
A massive jump. While on the flip side,
cigarettes do what they always do, continue that secular decline. Volumes dropped 3.2%, down to about 158 billion units.
So the strategy's working, right? They are replacing declining cigarette volumes with these high growth and, importantly, high margin smoke-free products.
Which, yeah, brings us right back to the puzzle. Why the massive sell-off? If the transition's working and the margins look good.
It all comes down to fear about the cost of that success. Are the expenses needed to stay dominant in smoke-free going up structurally? That's what the market suddenly got worried about.
And that worry really zeroed in on ZYN in the U.S., didn't it? The nicotine pouches.
Exactly. Management was celebrating, record quarterly smoke-free gross profit and adjusted EPS, but in the same breath.
They flagged higher commercial spending, specifically linked to aggressive ZYN promotions.
And they put a number on it, a specific sort of one-off hit of roughly $100 million just for ZYN promotions in the U.S.
Okay, $100 million. It sounds like a lot, but compared to nearly $11 billion in revenue, why did that spook investors so much?
Because the market read it as a signal, maybe a warning sign about future cost pressures. The fear is maybe this isn't a one-off. Maybe this is the new cost of competing hard in the nicotine pouch space.
Right. So management calls it a one-off, but is that just spin? If ZYN's facing tougher competition, surely they have to keep spending like this. Did they give any reason to believe it's temporary?
They tried to address that head on. The CEO insisted it was more of a one-off. He framed it as resetting ZYN's price position.
Okay.
And the CFO added some context. He said ZYN's earlier profitability was maybe a bit abnormal because they actually had supply constraints back then. They couldn't make enough.
So they didn't need to promote heavily before.
Exactly. Now supply is strong, so they argue they need to invest more aggressively in marketing and promotions to defend and grow their market share, maintain that leadership.
So the argument is basically, we took a short-term profit, hit this quarter, to lock in ZYN's dominance for the long run. It's an investment decision.
Pretty much, like a tech company spending heavily on user acquisition, even if it dings margins for a bit, they're playing the long game for ZYN.
Did it work? Did the spending actually boost sales?
Well, the immediate data suggests it did. U.S. ZYN offtake growth, that's sales off the shelf, accelerated to 39% in Q3 overall.
Okay, that's strong.
And get this, In September, after they really ramped up the marketing and promotions, that growth apparently jumped to 58%.
Wow. Okay. So the spending blitz did seem to drive significant trial and uptake, at least initially.
Which loops back to the margins. We should probably emphasize that point again. The overall smoke-free category gross margin expanded to 70% in Q3.
70% gross margin.
Right.
So even if you spend $100 million promoting it, you're defending an incredibly profitable business there. Maybe that spending makes perfect sense strategically.
That's certainly management's argument. And, moving beyond ZYN for a second, the other big smoke-free pillar, IQOS, is still performing very strongly globally.
Right. The heat not burn product, still the market leader.
Yeah, holding around 76% global volume share in the heat not burn category. And they just hit a milestone. IQOS is now available in 100 markets worldwide.
That's huge reach. But there was a little wrinkle with IQOS too, wasn't there? Something analysts picked up on.
Another point that probably fed into the market's nervousness, focused on the short term again, it was about inventory.
What was the issue?
Well, global HTU shipments, the units PM sent out, grew by that strong 15.5%. But in-market sales, or IMS, which is what consumers actually bought, only grew by 9%.
Okay. So shipments are growing much faster than actual end-user sales?
Exactly. And when that happens, it usually means inventory is building up somewhere in the supply chain, distributors, retailers.
Which isn't sustainable, right? It hides the real demand picture and means you'll likely have weaker shipments next quarter as that inventory gets worked down.
Precisely. It creates a guaranteed headwind. And that inventory issue for both ZYN and IQOS fed directly into what was probably the most damaging part of the earnings call.
The Q4 outlook warning.
Yeah. Despite beating Q3 expectations, they only nudged up the full year 2025 adjusted EPS guidance very slightly to $7.46, $7.56.
Just tightening the range, basically.
Right. And they immediately followed that tiny nudge with a very clear warning. Expect a slower quarter in Q4.
And the market hates hearing that, especially after strong results.
Yeah.
What's driving the slowdown?
It's mainly these tactical adjustments hitting all at once. First, those inventory unwinds we just talked about.
Okay.
They specifically guided for a ZYN inventory reduction of about 20 to 30 million cans in Q4.
And for IQS?
A reversal of about 2 billion units of that shipment timing benefit they got earlier in the year. So a big HTU inventory drawdown is coming too.
That's headwind number one. What else?
Headwind number two is taxes. The effective tax rate is expected to jump significantly higher in Q4 just to get the full year average back to their target of around 22%.
Okay, so inventory drawdowns plus a higher tax rate. That sounds like a recipe for a sharp deceleration.
It is. Put it all together, and their forecast for Q4 is pretty sobering. Only single-digit organic operating income growth.
Single digit, after 16.7% growth in Q3.
Yeah, and potentially only up to 6% currency-neutral adjusted diluted EPS growth in Q4.
Wow. Okay, I see why the stock dropped 9%, going from 17% EPS growth in Q3 to maybe just 6% in Q4. That's a sudden stop.
It's a significant air pocket, for sure. It feels like hitting the brakes. But, and this is important, management was really trying to stress their confidence beyond Q4.
Right. They were saying this is temporary noise. The long-term story is intact.
Exactly. They reiterated their belief in durable double-digit operating income growth over the long haul.
And they pointed to some supporting facts, right? Like overall volume growth.
They're still on track for a fifth straight year of total volume growth. Small growth, forecasted at plus 1% for 2025, but growth nonetheless, thanks to smoke-free offsetting cigarette declines.
And the full-year targets for revenue and OI growth, still holding.
Pretty much. Full-year organic net revenue growth still aimed at the lower half of their 6% to 8% range. And operating income growth still targeted at a strong 10% to 11.5%.
So the full year still looks decent, despite the Q4 dip.
That's the message. And they backed it up with, well, actual cash.
Increased the dividend.
Yeah. They raised the dividend again, 18th consecutive year, bumped it up to $5.88 per share annually. That's an 8.9% increase.
Nearly 9%. That's a pretty chunky raise.
It is. And they made a point of saying it was the largest percentage increase since 2013.
Since 2013. Why call that out specifically?
Well, 2013 was arguably a period of peak confidence in their traditional cigarette business's pricing power and cash flow. By explicitly linking this hike to that high watermark, the board seems to be signaling very strong confidence. They seem to believe this near-term spending and inventory stuff is just noise, and the underlying smoke-free engine is generating superior long-term cash flow.
Okay, so management's confident, backing it with a big dividend hike, but the market reacted with fear about Q4 and the ZYN costs. Quite the disconnect.
a major disconnect. Which brings us nicely to thinking about how the market priced this information.
Right. And now we pivot to our regular segment where we discuss market signals and potential trading ideas based purely on the call's data. We have to stress, as always, this is absolutely not financial advice, just an exploration of a plausible, if perhaps high-risk, idea stemming from the market reaction.
Definitely not advice. So the setup is this. The stock got hammered, that 9% bleed, right after the beat.
Yeah.
The market seems to be pricing in two main negative things. First, that the Q4 inventory unwind and tax hit will be painful, which is known. And second, maybe more importantly, that the higher ZYN spending isn't a one-off, but reflects permanent margin pressure from competition.
Okay, so the outrageous but plausible trade pitch starts by challenging that second assumption.
Exactly. The pitch argues the market completely overreacted to the ZYN cost issue, selling off a company 9% just because it's investing $100 million to defend a category where it enjoys, as we said, 70% gross margins. Maybe that's excessive.
The view here is that the $100 million wasn't a sign of weakness, but a rational strategic investment to protect a highly profitable franchise. Defending the castle, basically.
Right. They're choosing short-term pain for long-term gain in a key growth category. Meanwhile, the underlying growth trends for both IQOS and ZYN still look strong, and management did reiterate that long-term double-digit OI growth goal.
So the argument continues. This Q4 noise, the inventory stuff, the tax rate, the ZYN promotion debate, it's temporary. It'll wash out by year-end.
Which leads to the potential trade idea, a tactical long position in Philip Morris, betting that once this Q4 turbulence is over, the stock could recover significantly.
And how would you structure that, hypothetically?
One way to express that view, and not advice, could be using slightly in-the-money call options, maybe expiring sometime in Q1 2026.
So buying the right to purchase the stock later, after Q4 is done and dusted?
Yeah. The idea is you capture potential upside if the stock stabilizes in Q4 and then re-rates higher in Q1. That re-rating could happen once the inventory issues are confirmed to be over, and especially when management gives its initial outlook for 2026, hopefully reaffirming that strong growth story.
So it's a bet that the market overpunished the stock for short-term issues, and that the underlying positive story will reassert itself next year.
That's the core thesis of the trade idea, betting against the market's current pessimism on costs.
Okay, so wrapping this all up then, the big takeaway seems to be just how sensitive the market is right now to any sign that the transition to a smoke-free future might be more expensive than previously thought.
Absolutely. Even with record smoke-free gross profits coming through, investors are hyper-focused on the operating expenses needed to sustain that growth, especially with competitors stepping up.
The key disagreement really is interpretation. Is the higher ZYN spending a tactical choice by management from a position of strength, like they claim? Or is it a forced move due to competitive pressure, signaling permanently higher costs?
And that 9% sell-off tells you the market, at least on October 21st, leaned heavily towards the more pessimistic interpretation.
Which leaves us with a final thought for you, the listener, to ponder. Management sounds incredibly confident they just enacted their biggest dividend hike in over a decade. Is it possible the market got this one wrong? Is the Q3 sell-off just short-term noise obscuring a long-term strategy that's actually winning?
Something to think about for sure. The answer likely lies in whether those ZYN costs really are temporary or the start of a new trend.
Indeed. Okay, that's our deep dive into Philip Morris International's Q3 2025 results. Thanks for joining us.
We'll see you next time.